Hello and welcome today to Long Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab, and I am joined out there in the chat by my good friend Connie Hill. Connie's a great educator. She's a 20-plus year veteran of the financial markets, and she's a phenomenal education coach. She's there to help answer your questions along the way. So do me a favor. For those of you that are joining us live, ask a question in the comments and get that conversation going. If you're here in the recorded version, thank you for joining us. Leave a comment in the comment section. Any way that you join us, we're glad that you're here. Do us a favor, click on subscribe. We'll talk a little bit more about that along the way, but that helps you, it helps us, and it's a great way to stay connected to the Trader Talks webcasts community. But we're going to be talking a little bit about long options today. And my thought was in this discussion is talking about some of the common elements and consistent themes when it comes to long options. One of the consistent themes that comes up oftentimes when I'm out teaching live events is, well, why don't I just buy a much, much longer dated option and use that as a means to mitigate some of those time decay issues? And we'll talk about that and some of those concerns as we get into this discussion today. But a couple of quick reminders and housekeeping items that we need to take care of as we get into this discussion today. Remember, everything we talk about simply for illustrative and educational purposes only, and not a recommendation, not any kind of advice. Also, remember that options carry a high level of risk. They're not suitable for all investors. Make sure you're aware of the characteristics and risks of standardized options before considering any option strategy. In addition, remember that when buying long options, investors may lose 100% of the funds invested. So that is a consideration. Also, remember when you trade options, trading multiple leg option strategies will involve multiple transaction costs. Spread trading like that must be done in a margin account. And when we talk about those spread trades, I mean, the reason I even bring that up is the fact that anytime we create a spread, it's generally done with a long option and a short option. So long options got to fit into this mix as well. Of course, remember that as we talk about these things, we're going to be using the Thinkorswim desktop software platform. Specifically, the paper money version. It is not a guaranteed future success out there in the real world, but it is a great learning tool. And as we gain confidence using the paper money platform, keep in mind the fact that there are some differences between paper money and live trading as you move your practice from paper trading to live trading as you go forward. Also, remember that we're going to use technical analysis in this discussion as well. Technical analysis, not the only way to analyze the market, but it is theoretical, as is fundamental analysis, as is probability analysis. And so Schwab doesn't advise the use of technical analysis or any other single method as a sole means of investment research. Now, let's jump into this discussion here really quickly as we get into the Thinkorswim desktop software platform. I'm going to flip over here, and we're going to take a look at what's going on really quickly. I'm going to bring us up to our index grid. We'll just kind of see where the market is this morning. I taught the futures class this morning, and in the futures class, the market just at the start of the market was starting to push down a little bit, now kind of just sitting flat. And I think that's not at all an unusual nor unexpected concept, given the fact that we have the start of an FOMC meeting today. We have a holiday shortened week. So there are a number of reasons why there might not be a lot of movement, perhaps, in the market. So we're going to talk about that. We're going to talk about movement. We're going to talk about the long end of the long option perspective. And I like Sal's question here, talking about long options on that short end of the stick. On that 0 DTE or shorter time till expiration time in the game. So we'll talk about some of those things as we get into this discussion today in long options. But right now, SPX kind of running into a bit of a sideways move. The NASDAQ doing just about the same thing, as is the Russell 2000 kind of sitting right along that support level. So if that's the case, then my next question, and in fact, in the futures webcast this morning, we talked a little bit about volatility as a function of what stocks have been doing, and the fact that the stocks have been kind of generally, these indexes have been kind of going sideways. So what do we do with that? What does that do to volatility? So the next thing I'm going to bring up in this discussion is my VIX grid. So we're going to take a look at what's going on with volatility. This is the VIX, the volatility index of the market. Generally, this is a 30-period or a 30-day rolling moving average of in the money, at the money, out of the money options and their pricing. And so it's heavily influenced by option buying. When that price moves up, for those options, the VIX expands, the VIX gets higher. And when that volatility is met with selling pressure and gets sold off, those high premiums come down. That brings the VIX down. So here's where we are today. We saw a little bit of a gap up into a kind of a spinning top candle today. And not that the VIX operates with the same kind of elements of support and resistance that an individual equity does, right? The futures contracts do generally. The ETFs that track the VIX, those operate with that characteristic. But the VIX index itself, which is not a tradable instrument, simply behaves based on where that price is and what that price is currently at. So volatility relatively stable at the moment. Volatility relatively low at the moment. When we talk about relatively low, right? You got to kind of think this perspective, right? And Chris asks a great question. The VIX made a higher low yesterday. That's here. And the SPX made a lower high. If we were to look at the two of these in comparison to one another, you can kind of see that disparity going on, right? So are they coming back in? Yeah, but notice what's also happening here. You see this correlation between the VIX and the SPX kind of coming up off of the bottom. It's almost coming to not an inverse correlation, or not a direct inverse correlation, but really kind of a neutral correlation at the moment. So what that says to me as a trader and looking at this market and evaluating this market is that maybe both are kind of getting squeezed in kind of a wait and see mode. Now, wait and see modes for the volatility don't tend to last very long. You'll tend to see volatility move up or volatility move down. But when we get big spikes in the VIX, that comes as a function of news primarily. Are we in a situation at the moment where there could be potential news? We've got geopolitical events. We've got domestic political events. We've got domestic financial issues. We've got an FOMC meeting. We have a holiday shortened week. So there are a lot of potential news generating circumstances. So with volatility low, and one of the things to think about, I'm pop back one grid here on my VIX grid, is that volatility, and this is over the course of a 1-year period, but if I were to look back over, say, a 3-year weekly of the VIX, or even a longer time frame, right? So I'm going to go to a time frame that's a little bit longer. Let's go out to 15 years on the VIX. You can kind of see that the average for the VIX over that length of time is somewhere right around this 17 or 18 range. That's normally where the VIX stays. It's relatively low. And the VIX is right just above that area of its average. So that would suggest that volatility has gone up just a little bit, but not extraordinarily so. When VIX is low, this tends to be a mean reverting instrument. When volatility is low, it tends to rise. When volatility is high, it tends to fall. So with that being the case, my thought was looking for circumstances where implied volatility was relatively low. Now, one of the things that we can do is we can use the scan tool to do that. And I don't want to belabor doing a lot of scanning in this discussion, simply because I'm going to get to my single grid here, simply because I want to spend perhaps a little bit more time talking about the option strategy itself, rather than the specific symbols in terms of how we get there. So if I were to go to a scan tab, right, and then we're going to look at something like, whoops, I dropped my camera. Hang on. Stand by. Camera fell off the wall. Okay. Camera fell off of the table. So stand by for me for just 1 second so I can get things squared away. I appreciate your patience with me as I get this squared back away, and then we're going to jump back in. You probably prefer not seeing me on camera anyway, but we're going to put this camera back and make sure that that is all working once again. Better the camera than the laptop falling off the screen. There we go. All right, now we're back. Okay, thanks guys. Appreciate that. All right, who needs a camera? There you go. All right, so let's do this. What we're going to do is we're going to run a quick scan, and I'm going to reset my scans here. So I'm going to come back up here to reset. We're going to clear all those filters, and I'm going to look in all stocks. In fact, what I'm going to do is I'm going to come down here to the S&P 500. And we'll just come to the S&P 500, and I'm going to intersect with an industry. So one of the industries that I know has been moving recently has been in the energy sector. So I'm just going to look in all energy. All right, we've been seeing movement up or down, 21 stocks within that sector. So what I'm going to do is I'm going to actually change one of these filters. I'm just going to look for lower implied volatility. So I'm going to change this filter to actually a study filter. So we're going to go right here, add a filter. We're going to go to study. And I'm going to come in here and we're going to come down to volatility. And I'm going to look at IV percentile. Now, this is one of those differences between paper money and a live trading account. Studies will not work. Study-based filters will not work in a scan in a paper money account. So this is in a demonstration account made to look like a live account. It is a paper money account, but it allows for that. So what I'm going to do is I'm going to look for an implied volatility percentile, meaning how low is implied volatility in its range. And I'm going to look for a level that is between 0 and the 20th percentile. So in the bottom fifth of implied volatility. And in the energy sector, in the S&P 500. And I'm going to run that scan, and I'm going to see how many results I get. And I actually have a column header for implied volatility percentile. I'll show you where we see that on the option chain as well. But you notice the names here in the energy sector that are low implied volatility and relatively high volume. So these are all pretty liquid stocks. So we've got ExxonMobil, we've got EQT, we've got Baker Hughes, Marathon Petroleum, Phillips 66, and Valero. I'm going to take the top one on the list simply because it's probably the more recognizable of the names here in this list, and that's ExxonMobil. So I'm going to go back to my chart, and I'm going to plug in XOM. And we can see that ExxonMobil, as is befitting an energy stock in a period of significant geopolitical risk, has been on fire to the upside, right? And been ripping up from this kind of skewed double bottom. Doesn't mean that it'll continue to do that, but that's the premise, right? So we could buy the stock. Buying the stock by itself is going to be fairly capital intensive. But look where implied volatility is. If we look at where implied volatility has been for this stock, right? Implied volatility is still very low. It's in that sub 20th percentile, which means it's in the bottom fifth of where implied volatility has been. What that means is it's likely to move higher, okay? It's likely to move higher. If implied volatility moves higher, I want that to work in our favor, right? I want that to benefit us in this type of scenario. So what we're going to do is we're going to look at taking a trade on a long option. And we're going to look at a couple of different durations here, but with the expectation that we see implied volatility increasing. You can see that implied volatility at the bottom of the chart, low and rising. And that's what then puts me in the strategy selection area of choosing a long option. So I'm going to go to the trade tab here really quickly. And we're going to look at taking advantage of this upward movement. Now, some traders might say, well, look, this upward movement has been happening for 1, 2, 3, 4, 5, 6, 7, 8 days. It's already pretty long in the tooth. And I would argue that you're probably right, but at the same time, It's just barely made a break above this resistance level. And in fact, now it's tickling this resistance level right here. So is it already done? I don't know. Does it have some room to move? Probably before we get up to that next level of resistance, but I don't know. Technical analysis might suggest that. But buying a long option that is less sensitive to the passage of time, more sensitive to directional movement, more sensitive to a rise in implied volatility would allow us to mitigate some of the issues of time decay versus directional price movement. So here's what we're going to do. So we're going to go to the trade tab. And to Sia's point, Sia, I know that you were talking about something else. If we're talking about implied volatility going higher, that increases the premium. You're absolutely right. And then the exit should be juiced up because of that high implied volatility. And that's kind of the idea. Buy it when it's cheap, sell it when it's expensive, buy that implied volatility component of the option, and then sell that when it is expensive. So what I'm looking at here on the trade tab is down at the bottom of the option chain. I've opened up today's option statistics, and you can see that current implied volatility percentile number right here. And let me grab my annotation tool, and I'll show you where that is. That is right here, that current implied volatility percentile tool. That is essentially the same thing as that study that we were using on the market or on the scan tab in building that scan and looking for that implied volatility percentile. They're just two different names for the same thing. Current implied volatility percentile, 19% or the 19th percentile. If it's at the 19th percentile, low is generally low and rising unless we're seeing that trend. And that's what we saw on the trend of implied volatility. That implied volatility is likely rising. That's going to be beneficial theoretically for us as a long option buyer, right? Buying a long option. So let's go through our option chain here and let's see what we can do with this scenario, right? We could buy the long stock. That's going to be, again, like we said, capital intensive. Buying 100 shares of stock. We click on the buy on the ask price, click on confirm and send. We're going to tie up essentially $11,000, right, to buy the stock. Okay, pretty pricey generally. If we were going to go now to take advantage of that same directional movement, right? If we're going to come down here and let's say we buy 60 days worth of time. Let's say we even buy less time, right? 30 days worth of time. The next monthly expiration, which is the 18th of July. And we were to go to the in-the-money options, right? And we could go to, say, for instance, the 110 strike. The stock's currently trading at 114. That's in the money. The 105 strike is even further in the money. Higher deltas, lower implied volatilities the further in the money we go, or excuse me, lower theta numbers the further in the money we go, and as well lower sensitivity to changes in implied volatility the further in the money we go. Oh, so there's a trade-off here, right? Because we go deeper in the money and we're getting less theta, we're also getting less pickup on that implied volatility change, right? So this is where you as a trader, where traders have to make a decision, right? How do you view, based on what your expectation is for movement, how do you view what's going to be the biggest influential part of this trade? Is it going to be delta, directional movement? Is it going to be theta, time decay? Is it going to be vega, volatility change? So, I mean, if we're looking at buying an in-the-money option here, or an at-the-money option, delta is by far, you can see that to the tune of, about 7 or 8 times, it's going to be by far the largest impact, right? Okay. So we've got to kind of have that directional assessment. So we already had that bullish directional assessment. Now we got to factor in the other two ideas, right? So in this particular case, we're going to look at coming over here and going in the money. So I'm going to choose one that is just a little bit in the money, a little bit tighter bid-ask spread, about the same time decay, but a little more sensitive to implied volatility. And so we're going to go to the 71 delta, what is not really the at-the-money strike. The at-the-money strike technically is the 115 strike. But we've got a higher delta, so we've got more directional sensitivity. That's the 110 strike here in this particular case. So if we were to create an order, we're going to look at buying that, and we were to kind of walk this through. Now, instead of tying up $11,000 worth of capital, this is going to tie up about $655 worth of capital. That becomes then our theoretical maximum loss. And we start to kind of think through that scenario here. But let's send this over to the Analyze tab really quick. Right click, and we're going to send this over to the Analyze tab. Now, for those of you who have not seen the Analyze tab or used the Analyze tab, that's what this looks like, right? This is the Analyze tab. Analyze tab is profit and loss on the vertical axis, price of the stock on the horizontal axis. So we can see if we come in here and we were to set our price slices to, let's make our probability time frame July, and let's set our price slice to break even at expiration. That means as long as the stock is above 116.59 at expiration, we're making a little bit of money on the trade. Not much, but it doesn't have far to go. You can see where the price of the stock is now, right? And above that level is where our break even is. And so if we were to continue to move to the right-hand side, you can see as we were to continue to move up and up and up and up and up in the price of the stock, if it were to continue to go higher and higher, that continues on, in fact, to infinity and beyond. But it's not likely that ExxonMobil is going to go to infinity, right? So Jerry asks this question, and I think it's an absolutely valid question, and I think it's a great question to ask. What are the pros and cons of a long option trade here on ExxonMobil versus a long vertical trade? And this is the reason why there is that potential, and one of the reasons why there is a difference between doing a long vertical spread and a long option. And I think this is a great discussion, because if we right click on this option and we click on confirm and send, we have this word right here that says infinite maximum gain, right? Now, is ExxonMobil going to go to infinity? No, not now. Probably not within the time frame of this option contract, right? But could it go higher? Yes. Could it go significantly higher? Yes. Do those things work in our favor? Yes. They all do. But if we were to change this trade and limit this trade, now, by the way, this isn't a class on long vertical spreads, but I'm just going to talk about how we would construct a long vertical spread really quickly. Remember that spread trades must be done in a margin account. They're going to have multiple legs, and they will entail multiple commission or transaction costs. So if we were going to make this as a long option, what we're going to do is we're now going to we would add a short option to this mix. So we would add a short option to this mix. So we might sell, here we are in the July 18th expiration, and we are going long the 110. We might sell the 120, right? So now we're long the 110, short the 120. We've created a long vertical spread, and we expect the price of the stock to go up. But now what we're going to look at on the risk profile graph is what this looks like. So now our risk profile that previously extended up and up and up and up out into the future now is capped at the 120 strike, right? Because now if we were to put this trade together, we no longer have infinite upside. We have a capped upside. That's one of the cons, right? Is that it is a capped upside. One of the pros, on the other hand, is this option, this long call option that we were buying for $6.60 is now essentially at a net $1.48 cheaper cost because we sold that premium. So this is going to be a cheaper trade, less expensive trade, right? And again, that's the characteristic, right? So if we were to think about that, this long vertical construction versus the long option construction also, though, changes the nature of the trade, because what it does then is if we were to set our strike price, set our slices to break even, our break even is a lot higher in this trade. And the reason that the break even is higher in this trade is because even though we reduce the cost of the trade, we don't have that same component. So we've got the width of the spread plus the cost of the trade. Essentially, the cost of the trade is going to be, in this case, about, if we were to put it together as a vertical spread, about $4, right? So just about $4 there in that particular case. The thing about this trade, the long option, is it gives us that directional potential, that potentiality, right? That directional movement capability. This can be a frustrating trade. So we're going to take this off of the discussion. We're going to go back to this long option, and we say, fine. What are some ways that we can mitigate the impact? Because if we look at it now, notice here's our delta, right? We'll set our slice back to break even. Set our slice back to break even here. Here's our delta, about 77 long deltas. Our theta, though, is losing about $4.84 a day, theoretically, right, out of our option premium. But if implied volatility goes up, that's going to add more than that to the option premium based on that rise in implied volatility, right? So in this particular case, as we look at this trade, how do we kind of adjust this balance between time decay and implied volatility? Well, we kind of have to think about what we're doing here. We're closer to expiration, right? This is a trade that expires in, 35 days? So this gets to the next question that a lot of traders ask is, why can't I just, instead of doing this, why can't I just, let's delete that. Let's go back to our trade tab for ExxonMobil. Why can't I just buy an option? Because we know that theta sensitivity goes down the further out in time we get. So why can't I just go way out in time, right? Way out in time. So I'm going to come down here to the option that expires. Let's just say, all right, well, we're probably not going to stop using oil between now and January of 27. So what if I go to the January of 2027 expiration, and I come back in here and I buy the 110 strike? So it has pretty good delta, but look at the theta. I mean, that theta is very, very slow, exceptionally slow. That's something to think about. So we buy this option, still fairly tight bid-ask spreads. We click on confirm and send. We read through this order. It's going to cost us a little bit more than buying the 35 days to go until expiration option, but it reduces our time decay sensitivity. But what it also does, and in this particular case, what it's going to do is it's going to increase significantly our sensitivity to implied volatility. The reason for that is now we've got 577 days for the stock to do this, to go up and down, as opposed to 35 days for the stock to go up and down. So that's a consideration. So as we put this trade together and we look at buying this 110 strike, there's something else that we might want to consider. And it's smaller, right, in this construct, but it's smaller relative to other impacts, and it's not as likely to be an issue generally, unless circumstances are maybe when there might be an FOMC meeting when they're considering reducing interest rates. So here's the thing to think about is this option, and I added this column into my option chain. I added the option Greek rho, R-H-O. We don't normally talk about rho because rho generally is relatively insignificant. In fact, when we're inside of 30 days to go until expiration, rho becomes fairly insignificant. When we're down to 1 or 2 days to go until expiration, rho becomes almost non-existent unless you're right immediately ahead of, guess what? An FOMC meeting. And even then, it's not as big a deal. So we're outside of that range, but it becomes I'm on the odd lot option there. I don't want to be on the odd lot option. So now here we are on the regular option, right? And you can see that that rho is insignificant. So rho, much like volatility, like Vega, the option becomes less sensitive to that input the closer we get to expiration. But it becomes more sensitive to changes from time and from changes from gamma, the movement of delta, right? So if we're going to mitigate time, you got to take the trade-offs. So we go out further in time to mitigate that time decay. We go out to this January 27 expiration, January 15th of 2027 to be exact. And we buy this 110 strike, this is technically a LEAPS option, long-term equity anticipation security. It's going to cost a little bit more because we're buying more time value, but we're also reducing the sensitivity of time decay significantly. Now, if implied volatility goes up, and it goes up a lot, because that's kind of the scenario that we were looking at. Implied volatility is in that 19th percentile. The reason we looked at that 19th percentile implied volatility level is if we're going to buy more time value by going further out in time, one consideration would be to buy in a circumstance where implied volatility is low, so that that heightened sensitivity to implied volatility works in your favor. It doesn't take too many moves of 52 cents to the upside to overcome 1 cent of passage of time theta decay in your option premium. So if you're going to buy long dated options, if a trader is going to look at buying LEAPS options as a purpose, as the reason for maybe or a possibility of substituting for the ownership of the underlying stock, then put the factors that you can to work in your favor, right? And the factors that you can are the passage of time. So we're doing that by buying longer dated options. But implied volatility, look for a circumstance where implied volatility is low and could go higher. And remember, to think about this, implied volatility generally goes higher more frequently when the market goes down than it does when the market goes up. So if this just kind of dribbles to the upside, that implied volatility sensitivity is going to help us, and it's going to help us to a greater percentage, but it's not going to just blow the doors off of the increase in the value of this option. Because if we were to see a rate cut, that might decrease that implied volatility value. Now, of course, the rate cut is generally going to be a one and done type of scenario in terms of its news impact and its impact on the option market. This can happen and fluctuate. Volatility can happen and fluctuate on a pretty regular basis. So you got to kind of keep that in mind in this discussion. So we're going to go ahead and, just for the sake of this of completeness here, we're going to click on the the ask price for this 110 strike. We're going to look at what that trade looks like here real quick. We're going to go ahead and click on confirm and send, and I'm going to put this in my let's put it in our vertical spreads group, just so that we can come back to this. I know where it is. We'll click on send and we'll fire that order off, and we're filled. And again, one of the other things to think about perhaps in terms of buying those long dated options is the liquidity in those long dated options. Make sure that you've got narrower bid ask spreads. This was, 30 cents in this case. So that's for a $17 option at a 110 strike, 30 cents of a bid ask spread not outside the realm of possibility, for 577 days to go until expiration. Now, that's the long dated side of the equation. And there's lots of things that we can do with that. But that part of that comes from the fact that implied volatility is low and rising, and that works in our favor. And not that we have to hold on to this option for 577 days, right? We can turn around and sell this option at any time. So if that's the case, right, there might be a trade-off to be had in terms of maybe looking further out the duration curve rather than looking at shorter on the duration curve. If you have an expectation that implied volatility is going to rise, right, one thing that traders may do is consider buying more time, with the expectation being that the implied volatility sensitivity, that Vega number, is going to be higher. The implied volatility is going to be low, the passage of time, or that theta number, is going to be lower. Both of those things may work in the favor of a trader who's looking for a rise in implied volatility over a shorter period of time, but wants to reduce the sensitivity to whatever time decay does happen. And so that's why some traders may simply look out, when they're taking long option trades, may simply look out at one of these leaps options out into the future for the sake of mitigating some of that time decay. And that's certainly something that can be factored into a trading plan or structure or question. Where is implied volatility and what direction do I think it's moving, right? So JB asks the question, what would be the target on this ExxonMobil call option? And I'm going to argue in this particular case, the target in this case is more like a trend trade, because we're using that option really as kind of a replication for long stock. We're thinking about that as a replica or a substitute for trading long stock. So we may not put a take profit target on that trade. On the other hand, may very likely put an exit on that trade if it were to go against us to the downside in this particular case. So we might find a level of support. We might even make that level of support down around this 101 mark and just simply say, fine, I'm in this option. Let's do this. I'm going to come back down here to our, where do we put it? Vertical spreads. There it is, ExxonMobil. And so what I'm going to do is I'm going to right click. I'm going to create a closing order. And I'm going to say, look, I want to exit this position. I want to exit this position on a market order because I don't know what the option is going to be, what that option price is going to be. But I'm going to use the gear icon here. And I'm going to say, if the price of the stock breaks this 101.60 level, then exit me out of the trade. So I'm going to use that gear icon. And I'm going to bring up, oh, where did it go? I don't know where my... Oh, that's what it did. Stand by for one. Let's see if I can get to my dialog box. Huh. Stand by just a sec. Let me see if I can get to that dialog box. Because I think what's happening here, let's do this, display settings. Stand by with me just a moment. All right, let's see if now I can get to my dialog box. It might do that. It might not. It's not dialog box. And that here. So, all right. So what we're going to do then in this particular case, if I come back down, is we'll come back right down here. Okay, let's just kind of review what we've done here in terms of putting this trade on. What we're going to do is put and now because it's coming up and it's saying market order must have a daytime in force, right? That's why we're adding that conditional order. And we're adding that conditional order right here. The reason that this fell off is my monitor layout put it way down in the bottom. I can't get to it because I can't minimize the screen. So that's my fault. But that conditional order allows us to specify at what price we're looking at exiting that position, right? And as we're doing that, me box that is currently open. So that's why it's not letting me move to anything else. I appreciate your patience with me on this, but we're going to put that conditional order on there to exit that position. If the price of the stock moves down through that level of support, it's going to then exit that leaps option at any particular time when that happens and at whatever price that leaps option is. So we're using this essentially as a replica for the price of the stock moving. All right. So let me do this really quick. Let's pop right over here. Let me see if I can get to my education page. There we go. Now I might be able to take that off and come back into it. Anyway, yeah. Yeah, it won't even let me do that because that dialog box is open. We've run into this problem before, Leon, but I appreciate that. That's a very good point. So let's come over here and see if it'll do it. Yeah, the icon is not select in there. So we're stuck. So we're not done there yet. It won't let me edit it. It won't let me find it. It's just a characteristic of the display, right? All right, so let's pop back over here really quickly again, and I'm going to bring up this. So if you want to learn more about long options or about LEAPS options, this has been a taste of those LEAPS options. Here's what we're going to do. So just type into this search box right here on the Trader Talks webcast page, LEAPS. Long diagonals using LEAPS, long options using LEAPS, longer term view with LEAPS options. Connie's talked about it quite a bit. I've talked about it before. Barb's talked about it. We've talked about managing spreads with LEAPS options, utilizing those longer dated options. And remember, what we're doing by buying that longer dated option is we are reducing the sensitivity to time decay, which is the inevitable. We're increasing the sensitivity to changes in implied volatility, which is a likely possibility, and we're keeping that same kind of directional perspective, and we're using it essentially as a substitute for or in place of buying the underlying stock. Now, buying the stock, the option, not the same as buying the stock because options do expire. Even LEAPS options, they do decay away, even LEAPS options, and they don't generate dividends or voting rights. But it is something to pay attention to in terms of the comparison between a LEAPS option and ownership of the stock over a longer period of time. So that's where you find more information about it right here. Do me a favor, guys. Click on that subscribe button down at the bottom of the page, or when you get over here, click on subscribe, and that's going to keep you connected to the Trader Talks webcast page. We'd love to have you there. Also, you can join us if those of you who have been to our in-person events. We are going to be in New York next week with another Market Drive event, and then I know some of you are already registered for this, even though the event is closed. We're looking forward to seeing you there. We're going to be in Santa Clara doing the Technical Analysis and Option Strategies workshop, and then we're going to be back in New York doing the same workshop, Technical Analysis and Option Strategies. So crisscrossing the country to bring great investor education to you. We'd love to see you there. Connie, thank you very much for joining me and being out there in the chat. Thanks to all of you for being here. Thanks to our great production staff, Bree, Gabe, Andrew, and everybody else for taking part in this discussion and bringing it to you. Have a great day, everybody. We'll see you again very soon. Take care. Bye-bye.